depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation, and that's really what we're trying to do is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
And Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah, so we will, we will put the thing. We have put the thing under a microscope. I will say, nothing is going to come out of that that's going to change the view. I think that in fact we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it. But But is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation. And it was, 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
I think I would take that question this way. We saw a year of very high productivity growth in 2023, and we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run persistently above its longer run trend. I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, so you've got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here, and we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that, and that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December? And
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember, how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group of branded people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
The chairman of the Federal Reserve. That news conference ended almost as soon as it started. The Fed chair thinks we're restrictive. Here are the scores for you. In the equity market on the S&P 500, boom, vertical, almost straight away as soon as he started speaking. The equity market positive by 1% on the S&P, on the NASDAQ up by 1.1%. The small caps bouncing back from a very, very bad April. Here in May, up by almost 2%. If you switch up the board, once again, if it's a Fed decision day, apparently it's a rally for the 2-year. Yields are lower by 7 basis points, 496.22, and I think it's about 4:20 a.m. in Tokyo. Dollar yen looks a little something like this. I imagine the Ministry of Finance is a little bit happier. It could have been a whole lot worse. Dollar yen 157.49. Take a listen to what the chairman of the Federal Reserve had to say.
I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling.
Neil Dutta of Renaissance Macro with this line. The statement retains its easing bias. Powell believes the policy is restrictive. Look at the price action off the back of this, Bramo. The next 60 minutes of that news conference, next 50 minutes, hardly worth your time.
Well, especially because the next question was the question that was the key one, popping the question that Julian Emanuel was talking about, which is, have you considered a hike? How big is the threshold? Not likely. We're not going to do that. So it was a 1-2 punch. First, policy was restrictive, dovish. Then hikes are not on the table. Even a bigger rally. And frankly, that's what's fueling, basically, hawkish isn't as a vocabulary.
And Goldman Sachs in their note, Hatzius and Company in their note started with the tapering action. I think it was a tandem. I agree with everything you've said. And it was over, John, after not 40 seconds. I think it was over after 33 seconds. But with that said, he delivered a lot of what people wanted as an adjustment. You saw it in the real yield. It's come back a little bit, but you wonder what the follow-on is. The first set of Fed speakers out of the block. I mean, are they going to go with this tone?
It's been a fantastic lineup of guests over the last couple of hours. Just a shout out to Bob Michael of JP Morgan and Mohammed Al-Arian. Asked about stagflation. Do you remember Bob's response to that? I think the chairman's going to laugh at that. Reflect on what happened in the Volcker years. I think he's going to laugh. He said there's no stag, there's very little inflation. Ultimately, there's no stagflation.
Basically, he laughed. He said, give me a break. This is not what we're talking about. Honestly, this was a Fed chair that came out much more dovish than anyone had expected. And honestly, this raises a question about whether he is entertaining some of the key debates. He was asked by Michael McKee about long-term neutral rates, not going to engage it. Asked about long and variable lags, sticking to script. There was no sense that he had entertained a lot of the fundamental debates that are dividing Wall Street in a really serious way, and I'm not sure where that leaves people.
I noticed that off the GDP, where we got a 1.6% statistic, what we heard interview after interview was domestic final sales was actually pretty buoyant, and that's what he alluded to when he went after the stagflation.
Let's be clear, they're not going to cut anytime soon based on what we just heard. The easing bias remains It's just the amount of price action we've seen over the last couple of months. When we talked about the Fed chair being hawkish, it was hawkish relative to what? We've had this conversation all day. Relative to the previous meeting, maybe. Relative to the price action, where we're priced for right now, very difficult to do. The bar for that was so high, given the fact that this market is only priced for one cut in 2024.
Yeah, this didn't push against that. I mean, this could very much be consistent with only one rate cut. And that's why you're seeing a bigger move, arguably, in stocks than in bonds. Basically, this is the perfect mix for stocks, where people said you just need the tail risk of a hike off the table. He did that. And then you can really go to the races.
When we get to Dudley, I'm going to talk about what wasn't talked about too much, which is the labor economy. What evidence do they need to see in the labor economy to really become accommodative? And to me, that's still really unanswered. I don't think it's claims. Maybe it's wages coming down, a la Tom Porcelli and others. But I just really wonder what the labor dialogue is here rather than the parlor game of what inflation.
TK, you're right, but I would pair that with inflation. I think that's really important.
Well, they have to
Would these hot inflation prints temper their ability to respond to adverse shocks? The so-called Fed put, based on what we just heard in the last 60 minutes, the Fed put is alive and well.
Basically, stagflation's not on the table. Stop it already. And that's basically what we heard.
Can you set up a course where we have Frankfurt and London question quality brought over to Washington? Can you arrange that?
Would you like me to offend everyone?
No, I'm going to say it right now. There are too many questions that are off topic of the dual mandate of price change. Ethan Harris on fire on LinkedIn on this, and on the labor economy. I didn't hear enough about the labor economy.
I have to admit, I disagree with you.
You're going to defend the press.
I want to defend
disagrees with me.
I felt like after the first two questions, people tried every which angle to get something more. It wasn't happening. Period. Full stop. He was going to say what he was going to say, which is essentially, we haven't shifted our stance that much. We're not going to hike rates. Goodbye. See you next time.
Let's speak to a man who's been on the other end of some of these questions. Bill Dudley, former New York Fed president and Bloomberg Economics senior advisor. Bill, what did you make of that performance in that news conference?
I think your interpretation is exactly right. It was quite dovish. I mean, he basically said that despite the news that's come in, economy stronger than expected, inflation not so good in the first 3 months of the year, the whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike. No hint that it's not going to work. So market reaction, I think, was pretty appropriate given what he said. He basically said, we've got it.
Back to Dudley McKelvey of a few years ago. Bill Dudley, you're in the trenches at Goldman Sachs gaming the labor economy. What data in the labor economy is important to Chairman Powell to really become accommodative?
Well, I think it's the notion that the labor market is really starting to somehow fall apart, and the unemployment rate is starting to rise significantly. He was asked pretty explicitly about that, and he basically said 1 or 2 tenths of a percent rise in the unemployment rate wouldn't really disturb him. I think the interesting question is if the labor market really starts to deteriorate, the problem is that the next stop typically is a recession. We've never had a 0.5% rise in the unemployment rate without having a recession. So I think it's, if the unemployment rate goes up a couple tenths, I don't think it really bothers him. But if it feels like the labor market is really giving way, then the Fed will put a lot of weight on that, almost regardless of what inflation's doing.
Bill, you said something. He basically said, we got it. The playbook hasn't changed. Was that the right move?
Well, time will tell if the playbook will actually work as well as he thinks. I mean, my own personal view is that the legs of monetary policy probably are not as long and variable as he thinks. And I put a lot more weight on financial conditions, I think, than he is currently. The fact that people are taking his comments in a very positive way from a financial market perspective means that we're having an easing of financial conditions, which will support the economy. So I think it just reinforces the higher for longer story over the medium term.
He doesn't seem perturbed about that. And he also didn't really deal with a lot of the fundamental questions, as we were just saying, that have been dividing Wall Street. Didn't address the higher terminal rate. He didn't address this question of what would make him really second guess the whole idea of restrictiveness or long and variable lags. Do you think that means he's not thinking about it, or that he has rejected it? Or do you think he just doesn't want to deal with it in the public right now?
I think he's certainly thinking about it, but I think he's basically saying, from his perspective, the evidence hasn't convinced him that they're on the wrong track. So he thinks policy is restrictive, sufficiently restrictive to do the job. So maybe our star, maybe the neutral rate is a little bit higher, but it's not as high as where they are today. So yes, could our star be revised up at the next June summary of economic projections? Probably will be revised up a bit. But policy in his mind is still sufficiently tight that he's not worried about that particular variable.
Bill Dudley, Ethan Harris has been on fire, retired from Bank of America, out almost daily on LinkedIn with really intelligent work on trimmed inflation means. Which inflation statistic is most informative now to our audience?
Well, I like to focus on services ex housing for two reasons. Number one, this is the problem where the wage inflation drives the actual outcome in terms of services inflation. And number two, it's not being bounced around by the supply chain normalization process, which is pulling down goods prices. I think one of the things that's probably distorting the inflation news recently is the fact that goods prices came down a lot because of the normalization of supply chains. But if we ignore the transitory inflation on the way up, we also have to ignore it on the way down. So we don't want to overstate that goods price inflation weakness. So I think services sector ex housing is probably a really important thing to focus on, and that's the so-called last mile of inflation, and that's the part that's turning out to be more difficult.
Bill, we need to talk to you about the balance sheet as well. So the Federal Reserve announcing today they'll slow the pace of balance sheet runoff starting in June. The central bank to lower the Treasury runoff cap to $25 billion from $60 billion. Bill, market participants right now trying to work out, okay, if QT wasn't bearish, is tapering QT bullish? Bill, can you help me understand? Because we were told it's like watching paint dry. It has been. When they start to undo it, unwind some of it, what does it all mean?
I think it is like watching paint dry. You can see that in the press conference today. There were virtually no questions about the balance sheet. And he made it very clear that the balance sheet decisions are not a part of the monetary policy process of making policy either easier or tighter. I don't think it has much effect, the taper, because the destination is the same. The Fed's going to a balance sheet size that generates reserves that are ample but not abundant like they are today. So we may get there slightly over a longer period of time because we're now running off securities at a somewhat slow pace, but we're going to the same place. And so it really has virtually no market implications.
If you were on the Fed still, Bill, would you have voted for this type of thing? Or would you have erred a little bit more, as you were talking about before, about financial conditions easing too much to allow inflation to stay sticky for too long?
I don't think we're at this stage where rate hikes are warranted, and so I would have agreed with the decision today. I think where I would have maybe differed from Chair Powell a little bit is I would just be a little bit more cautious about the confidence that he's got it.
Bill Dudley, thank you, sir. The former Fed New York president. Bill, fantastic as always. Your equity market fades a little bit. We're up by 0.75%. Lisa, I appreciated the question at the end of the news conference. I'm not sure about the answer. Because effectively what the journalist in that news conference was asking is whether the lack of dissent spoke to a lack of diversity of thought on the FOMC.
Correct. They weren't asking about, what gender and
precisely
what, racial composition is on the Fed. They were asking about pushback, intellectual discourse, and this question about whether anyone was saying, hey, wait a second, maybe we shouldn't be so sure that long and variable lags have the same kind of effect as they have in the past. That, I think, is a legitimate question. He didn't address a bunch of questions.
Out here alluded to, and I think Bob Michael's been leading on this, and I mentioned Ian Lingen earlier, what if we get friendly data? What if we revert to a disinflationary vector? John, I'm doing some research here, and I mean, I look at the G7 meeting in Puglia.
Trying to make that
here
happen.
in June, and yeah. I'm sorry, I got a plane ticket of $3,006, not even close to $7,000 8, 9, 10 months ago. I'm sorry, you get whispers of service sector disinflation, and you're right back to the boom economy, Dow up 500, what it was 10 minutes ago.
I'll repeat the question I asked a little bit earlier before the news conference started. I'll ignore the reference of the Dow. The 3-month average on payrolls is 276. The Federal Reserve Chair has just conveyed quite clearly that the Fed put is alive and well. They're willing to respond to adverse shocks, downside surprises, particularly if they emerge in the labour market. Now, I'm trying to wonder, Lisa, what it would take to reintroduce the rate cut conversation. Clearly, they still have a bias to ease, to cut interest rates. Would it be a downside surprise on Friday? Would that be sufficient? What would we need to see to get people talking about a different thing? Not about hiking, about being sufficiently restrictive. After what we've just witnessed in that news conference, what would it take to have a series of guests to start talking about July at the Federal Reserve?
And Jay Powell himself might have said, well, it would take a substantial weakening in the labor market. Does this market believe him? that it really would? Or do they think that just the idea that, yes, quits rates are increasing, see a slight increase in the labor market, and then to Mohammed's point, if you already see the weakness, it's too late. How much does that haunt him at a time where he's really embracing the recovery that we continue to see in the economy?
Mike McKee was in that news conference. Mike McKee has run out of that news conference. He's with us right now. Mike, great exchange with the Federal Reserve Chairman in the last hour. What stood out for you?
Well, I think that the biggest thing is that there are two audiences here, or two people that, or two things that the Fed is trying to address. One is the markets and their perception of what the Fed is doing, and the other is the economy and what they need to do to bring down inflation. And the two things are not always compatible, and that's maybe what you have right now. The Fed is less concerned about how the market feels about all this than they are with setting their own parameters within their meeting of what they think they need to do. And at this point, they don't think they need to do anything. The economy seems to be in good shape. We've seen a little bit of a slowdown, but we're supposed to see a slowdown when they raise rates. We have seen inflation stall out. Maybe that means they haven't got policy tight enough, but now financial conditions have tightened, and so maybe that's going to start to work. Bottom line, they don't know what they're going to do, so they can't then give the markets a good clue.
Mike, in the fan distributions of all this data, the probabilities, the outcomes of all this data, is there in place into the jobs report on Friday an ability to get back to a disinflationary vector quickly?
Probably not, in the sense that we don't have any indication that hiring is going to significantly slow, meeting any of the conditions that Jay Powell was talking about for a rate cut. And wages, from all the other measures we've seen, have still been running above inflation. So at this point, one indicator isn't going to do it. It would take much more than that. If we got a significant rise in unemployment for some reason, then that would set some antenna up, but it wouldn't push anybody to do anything at this point.
Mike, we talked a lot about how the key question was going to be whether they were entertaining the idea of rate hikes. Were you surprised that he completely dismissed that outright?
No, I wasn't surprised because, Lisa, you just have to play game theory and ask, what would have happened if he didn't dismiss it? Then all of a sudden you've got people really moving the markets around, trying to price for something like that. At this point, the Fed doesn't see a reason to raise rates because they think that overall the economy is slowing a little bit as they want it to, and it is doing so without rise in unemployment. So things are kind of working out the way they had planned.
Mike McKee, great work as always, buddy. We'll catch up with you tomorrow morning. Mike McKee there, breaking it down for you down in Washington, D.C. That pop in the equity market getting sold just a little bit. We're still positive, but Tom, only by 0.4%.
Can I go to November 7? November 7 is 2 days after a modest election. I'm sorry, but that's the meeting I'm focused on. November 7 could be wild.
Hey, he was pretty direct about it in the news conference. They do not want to talk about politics at all. Not part of the conversation.
And they want to give the sense that they truly are independent at a time where they're actually being challenged in terms of their independence. The more people start talking about, when people, I mean, the former President Trump comes out and starts talking about the potential for, taking ownership over Fed decision-making, they're going to be that much more adamant about being
I'm waiting for him to address that story that came out from the Journal in the last week. Still anonymous sources around the president talking about these issues. These are big issues.
Don't you feel like people are kind of like spitballing out there and seeing how the people react to it before before they really kind of put any emphasis behind it?
Jeff Rosenberg's got things to say about this. Joins us now from BlackRock. He really doesn't.
Not that.
Stick with us, Jeff. I'm not going there. Don't worry. Jeff, it's great to catch up with you as always, sir. After what you just heard, does it make you incrementally more bullish in any way, shape or form?
Well, let's just say that going into this meeting, there was a lot of bearishness and fear that he would come out more hawkish. If you even look at, Bloomberg Economics put out their kind of preview, it was overwhelmingly expecting a very hawkish message. So I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman. He's been very much on the other side, has been one-sided, looking at the glass half full and reiterating, kind of the key point around an asymmetric response function. If inflation is higher, and it has been higher over the last 3 months, okay, we won't cut as soon as we were anticipating. But the questions and people who tried to pigeonhole them on, are you going to hike? Did you talk about hikes? Just deflected all of that, and that was a relief. So the reiteration on the asymmetry, as a result of the reiteration on they believe that policy is sufficiently restrictive. Those are two key things here that keeps a more dovish orientation in the face of some challenging economic data.
Jeff Rosenberg, on Planet BlackRock, is the economy doing okay? Is the real misestimation here a 1.6% GDP, which made a lot of news, but domestic final sales were much, much better? Is it better out there than we actually think, and that's why we heard a dovish Powell today?
Well, I think you have a mixture there, and you've heard it, as part of the exchange during the Q&A. The aggregate data, yes, 1.6 understates it because, as you rightly point out, if we look at domestic demand, it's running at a stronger level. So the economy in aggregate terms is stronger. But what Bob Michel talked about in the earlier, or Michael, I'm not sure which way you pronounce it, talk about is, there are pockets.
Was that some BlackRock shade?
Yes.
Is that what that was?
That was 100%.
Over at JP Morgan. I can confirm it's Michael. Carry on, Jeff.
Thank you. So there are pockets of hurt going on here, but there are also pockets of strength. So you have a distributional aspect in terms of what's going on in terms of the economic growth side, but clearly the amount of slowing, it was a question in the Q&A, didn't you need to have more pain to get the disinflation? Good news is we're still on the path of the immaculate disinflation, and the growth side is holding up. So I think that's quite supportive here to the risky asset perspective.
It seems like this is more supportive to the risky assets than it is to government bonds, right? I mean, this basically raises the specter of taking a rate hike off the table, which will benefit stocks of companies that have done really well with respect to earnings, but doesn't necessarily give that much of a boost to government bonds that are still subject to higher for longer. Is that kind of your view in terms of positioning on the heels of this, on the margin?
Yeah, and I think we have to segment between the front end of the curve and the back end of the curve. I think this is challenging for the long run in the back end of the curve, right? The Fed is for the most part dismissive of the inflation increase. They're not really taking it in too much into account. The characterization of it was bumpy, what me worry. So that's fine, but if you're holding 30 years of debt at interest rates that, may not sufficiently compensate you if you are at a longer period of a 3% inflationary period, that's a bit challenging and a little bit problematic. I think for the front end of the curve, it's a little bit easier story because you have less exposure because of the maturity and roll down that you benefit from there. But I think you have to be a little bit concerned about the longer run trajectory here, both from what we heard today in terms of monetary policy, but the other side of this, which we heard a little bit this morning in terms of Treasury refunding on the fiscal side, that's a bit more of a challenging environment for back-end duration.
Hey, Jeff, I want to build on that just a little bit. Given how established the reaction function is now at the Federal Reserve, highlighted again by the chairman in this news conference, how do you think yields will respond to the longer end to incoming information, the data on Friday, an upside surprise versus, say, a downside surprise?
Yeah, we're gonna pivot right to Friday, and we'll be back and we'll talk to you guys then. But I think that will very much be more about the front end reaction, because that's going to be about, is the Fed really getting the slowdown in the labor markets, the normalization in the labor markets that they keep talking about, but the data isn't really supportive. Non-farm payrolls not supportive, wages not supportive.
Right.
I'm a little surprised you didn't get more pushback on ECI, their favorite measure. Everybody expected it to go down. It went up. Yes, we can dismiss it. It had special factors. It was a bit more state and local. It was a little bit more union than private. But it didn't go down as fast as the normalization would say. And there is that kind of lurking question. Mike McKee, you asked it. Are you not as restrictive as you think you are? And they'll continue to believe that they are restrictive. That's kind of the fundamental belief at this point. The question is, if the data keeps pushing against that, then does the Fed have to make a bigger pivot? Today was not that day, way too soon to get there, and that's why Powell purposefully came out very dovish. But inside the statement, one questioner picked up on, there are a little bit of hints here of moving around. The removal of kind of the implicit forward guidance on the peak policy rate, the implicit promise that the next move would be a cut in the introductory statement. I think that's notable. We'll see that in the minutes in terms of the debate. And what the chairman obviously couldn't talk about here, but next month we will talk about, is the shifting in the distribution of the voting members with respect to their forecasts of economic policy. That you didn't get this meeting, but obviously that's what the markets wants to see. And you can kind of read into the statement and the press conference that there is a shift going on there. It was underplayed. Not really many people picked up on it. He wasn't going to highlight it, but you can see that is going on.
BlackRock's Jeff Rosenberg. Great to catch up with you, sir. The shade of JP Morgan from BlackRock.
Oh, stop.
Do you think they call Rick Ryder?
You know,
over at JP Morgan?
It's a fair mischaracterization. You think that was intentional? That was your takeaway from all the Fed coverage?
Absolutely was that intentional.
Bob,
Are you joking?
Oh,
of course it was. They don't know who Bob Michael is. Give me a break. This S&P 500 is fading going into the close. Let's bring up the chart briefly. We're up now by only 0.1% at the peak. In that news conference, the S&P 500 was positive by 1.2. Something that sticks, though. Interestingly, here, Lisa, is the rally in bonds. The 2-year still down by about 8 basis points.
It took the prospect of hikes off the table, so that potential tail risk, not necessarily there. I thought what Jeff Rosenberg said, though, about the long end was interesting, and we're not seeing it in the price action at all.
Same.
But that in the longer run, this becomes a real problem for the long end. Essentially, if you have a Fed that is hardwired to cut rates on any weakness, but not necessarily to hike rates on the sense of any kind of durability of inflation, does that mean that inflation is going to stay higher for longer and that there needs to be a higher risk premium?
I was pleased you took the conversation there, Lisa. This from Mohammed Al-Arian out on X, formerly known as Twitter, with this to say, the question now, this is an important one, which will only be answered in a few weeks when the meeting's minutes are released, is the extent to which his remarks reflect his own biases or constitute an accurate summary of what was discussed by him and his FOMC colleagues. And the Fed speak's going to start pretty immediately, Tom. Almost straight after this, going into payrolls, we're going to hear from Fed officials.
I agree, the Fed speak's important. If we get a 240 on survey on non-farm payrolls, 3 months trailing, 240, 303, 270. That's a fully employed America.
Well, and you raised a real interesting question, which is essentially, is there now a new asymmetry in the market where the long end will sell off disproportionately if we do get a really big or hot print in the labor market? Essentially, the Fed's not going to look at this as a reason to hike or even to keep rates higher for longer necessarily, but it could mean longer term there could be a much more inflationary pressure under the hood.
Really important stuff ahead of payrolls on Friday. As Tom mentioned, the estimate in our survey, 240,000. The previous number, 303. Coming up next on The Close, counting you into that, about 15 minutes away, Seth Carpenter, Chief Global Economist at Morgan Stanley. For the three of us, we'll see you again. Same time, same place for the next Federal Reserve decision. From New York City, this was The Fed Decides.
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
On the next
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele.
And I'm Scarlett Fu.
Quite a day today. We had that big Fed meeting. We had a big Fed decision, a decision to hold rates steady, a decision to slow tapering, but more importantly, an eye still on that soft landing. And at least if you believe what Jay Powell had to say, and I'll just quote him directly here, guys, it's unlikely that the next policy move is going to be a hike.
Yep, it is a hold and not a hike. That was very clear. Market reaction quite interesting. You did see a nice spike up within the equity market, but now the S&P has erased most of those gains, just up by about 0.1%. The buying continues, though, particularly in the front end of the Treasury market, with yields down by about 8 basis points. The dollar obviously trading really heavy around the lows of the session. And oil, guys, this is quite interesting because if you have commodities, and you saw it with the ISM and prices paid, if commodities are the thing that's been lifting up inflation expectations, if the commodities then roll over and oil demand is a little heavy, inventories are building here in the U.S., maybe that could be then a positive.
Yeah, a lot of things to think through. But again, it all comes back to what Jay Powell said, downplaying the likelihood that the next move from the Fed would be an interest rate hike.
I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data.
Jay Powell there, of course, at the press conference. And, of course, Romaine, the
expectations coming in seemed to be that the Fed would do a hawkish hold. I'm not sure that that was a hawkish hold.
It wasn't all that hawkish. I mean, it definitely sort of threw some cold water on this idea, but the fact that he still is sort of eyeing this soft landing, and he made it clear to the markets. I mean, how much more explicit could he have gotten here that a hike really isn't coming?
Pretty not at all. He definitely said it.
He definitely
He literally
said it.
said
In
those
fact,
words.
that press conference could have been a heck of a lot shorter had he just dropped the mic and walked off. Keeping an eye on that press conference was none other than Seth Carpenter, former Deputy Director of the Division of Monetary Affairs at the Fed, currently Chief Global Economist at Morgan Stanley, and he won't say it, but I will. Future Fed board member. Great to have you here, Seth. I know that's a lot of pressure on you. What did you make of the communication? Because we came in with the expectation that all the dovish talk that we've been getting out of Powell and the rest of the Fed members going back to December, that they were going to have to walk that back to a certain extent. Did they?
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that. The market discussion was all about should we start pricing in rate hikes, and I think he was, in fact, quite clear that's not where they are. And so he left optionality open, but with a clear downward bias. I thought it was pretty clear. Yeah.
If he winds up, though, pushing out cuts this whole year, would no cuts then eventually be a hike?
I mean, I think that's the interesting thing. Right now, the markets are pricing in a cut this year, a little bit more than a cut. And if they don't deliver on that, the market's going to have to adjust. Front-end yields will have to come up higher. So in that sense, I think it would be on net a tightening of policy, absolutely.
So everything's going to be data dependent. That's the Fed's favorite phrase. They're in wait-and-see mode. What's the data point that's going to be the one that is instrumental, that's going to kind of convince Jay Powell and the rest of the FOMC that they need to make a move?
I think there are three things they're going to pay attention to: inflation, inflation, and inflation.
Which one, though?
So sleep through Friday, apparently.
It was remarkable. I mean, when asked about what data he's watching, I thought Chair Powell was interesting. He said they're going to look at everything. We can look at inflation, we can look at inflation expectations, and everything else. He has said, based on this new information we have about the extra immigration, the bigger labor market, that the economy is bigger but not tighter. And I think that means that they're not sure that they can just look at how fast the economy is growing as an indication that they're doing their job or not. So that just leaves them looking at inflation. Now, we think we are going to continue to see inflation prints coming down. We think there is more noise than signal in the last 3 months worth of inflation data. And for that reason, we've been, out of line with the market a bit, expecting more cutting than what the market's pricing in. He set us up for that, so thank you, Jay. But now we need the data to come through, and it really will be the inflation data, May 15th CPI.
Well, based on what we heard today and based on the data that you're looking at then, Seth, do you think that at the next meeting, when we get the next projections, financial projections out of the Fed and the update on the dot plot, is that dot plot going to go down in terms of the number of cuts?
I mean, that's going to be extraordinarily tricky because there's not that much new information. I will remind you, though, I think they get another CPI report on the second day of the FOMC meeting, so it's going to come down to the wire. So I was a staffer there at the Fed when the dot plot was created, and there was always the expectation that...
you were responsible for this. Okay.
I like the dots. For what it's worth, I like them.
Wide range of disagreement, wide range of views, let's put it that way. But this will be a time where they very potentially will come into the meeting thinking they're going to go in one direction. They'll get the data on the second day, and they have the ability, if they want to revise their own dot and their summary of economic projections on that second day.
What do you think? Why do you think that policy is restrictive enough?
Why do I think it, or why does Jay Powell think it?
I mean, kind of both. I mean, because the financial conditions would indicate something very different. And he was asked this question, and he did point towards the labor market is cooling / slowing, et cetera. What else?
I mean, I think this is a challenging question. He was unequivocal there. I think I tend to agree with him. You can look at lots of things. The level of activity in the housing market fell dramatically. Housing starts fell. It's bottomed, and we're starting to see a little bit of a recovery, but in terms of the level, it's still quite low. So that's the normal channel of monetary policy, and we're seeing it. If we look at bank lending, right, usually part of the transmission channel, and their C&I loans are on net off their peaks and sort of very gradually trailing down. Cost of funding for banks on average has been rising as the composition of deposits is changing. So I think you can point to lots of indicators to say that, yes, policy is in fact restrictive. But it's not the only game in town. We have had an impetus of fiscal policy, right? And so you got to look at the net of what's going on. I mean, we'll remember in the decade between the financial crisis and COVID, we had really, really, really accommodative monetary policy, zero policy interest rates, big QE, and we were getting 2% growth. The reason for that is we had, between 2012 and 2016, restrictive fiscal policy. So you can't just look at what's going on and ascribe all of it to monetary policy.
All right, Seth, always great to catch up with you on these days. Always great insights. Seth Carpenter there helps lead the economics coverage over there at Morgan Stanley. As we count you down to the bells, guys, interesting reversal right now in the market. Remember, we had seen that big spike, that big bid come into equity markets. The S&P 500 was up more than 1%. So too was the NASDAQ, both now falling into the red as we get closer to those closing bells.
Yeah, you definitely see the sectors pretty much split. Utilities, the best performers, of course, your traditional safe havens. Energy stocks down about 1.6%, Alex, to your point about what we're seeing in terms of movements in commodity prices.
Yep, crude off 3.5%. I mean, that's going to hurt for sure.
4.953 right now on a 2-year yield. The rest of the market also on the back foot with just about 2 minutes into the closing bell. Sit tight. We're about to take you to the bell and beyond.
The Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast on this Fed Day with Carol Massar and Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Carol Massar, this was a market that really seemed to like what they heard out of Jay Powell. They bid stocks up pretty fiercely while he was speaking. But those gains now evaporating as we march closer to those bells.
That's what's fascinating. We were just talking with Doug Sioka over at Kavar Capital Partners, and that's exactly what he said pretty much, and I was tracking the numbers. We are pretty much exactly where we were, certainly on the equity side of things, just prior to that Fed decision. So quite a ride, and it's interesting where investors are like, okay, folks, we're back where we started, essentially, before the Fed came out and talked about the economy and talked about rates.
Yeah, I think also a bit of relief that Jay Powell said the next move, not that many people were expecting it, but there has been some talk of it. The next move from the Fed will unlikely be a rate hike. Also, Alex, no signs of stag or inflation out there, which I thought was a nice comment.
We want a rap song. We think there's a rap song in there. Stagflation, stagflation. No.
Keep going, Carol. Keep going.
It's going to happen.
Don't do it.
It's going to happen.
But I also think, Scarlett, that if you take a look at what's leading the declines now in the S&P, it's energy when you have oil off 3.5%, and then some tech, and that's really Skyworks Solutions, and that's a semi company. So it's a very specific move lower.
Absolutely. I also want to point out that typically on Fed days, you don't have a lot of volume. Volume was heavier than average leading into the 2 p.m. announcement, and really took off right when the press conference began. Now 26% above the 20-day average.
All right, we get the closing bells here in New York, and as Carol, I think, was just pointing out here, this really was a round trip here on the day. Stocks pretty much going to end the day kind of where they were prior to the meeting, despite a big spike that we saw in the middle of Fed Chair Jay Powell speaking. The Dow Jones Industrial Average higher by about 86 points or 0.2%. But the S&P 500, which was up more than 1% on the day, going to close lower by 0.3%. Similar trajectory for the NASDAQ, which is also lower by 0.3%. The NASDAQ 100 down 0.7%, and the Russell 2000 holding on to some gains on the day, going to close higher, Alex, up 0.3%.
All right, guys, let's go to Qualcomm, just out with their earnings, and I'm going to go right to the outlook. Let's start there because they're looking at third quarter revenue of $8.8 to $9.6 billion, quite a range there, and it is at least on the upper end of that, above what the street is forecasting, which is $9.08 billion. Stock up about 2.5% aftermarket. Sees third quarter adjusted EPS of $2.15 to $2.35. That again on the upper end looks like it's certainly above the street estimate is $2.16, and sees, as I mentioned, the third quarter revenue going backwards. Second quarter adjusted revenue $9.39. That was a slight beat. Street estimate was $9.32, and second quarter adjusted EPS of $2.44, and that, Scarlett, was definitely a beat, $2.32. So investors like it. 5.5% here in the aftermarket. Stock is up about 16% year to date, but we're going to look for some more color on that smartphone market.
Absolutely. Qualcomm, of course, the biggest maker of smartphone chips, so its results are really a proxy for the health of the smartphone market. And And especially in the case of a company like Apple, we've seen what's happened with the smartphone market, losing its competitive edge in markets like China. The big question, I think, here, Tim, is how AI gets incorporated into Qualcomm's outlook.
Yeah, that is a big question. I'm going to be looking for in the press release to see if there's anything there about that. Also from the call a little later, if anything is mentioned about that. Shares up by 4.3% right now in the after hours, bouncing around a little bit. The headline, though, third quarter revenue, Qualcomm sees it coming in from $8.8 billion to $9.6 billion. Estimate was for $9.08 billion. So that's some good news there for shareholders.
Yeah, just looking at the earnings release a little bit here in terms of AI and how it impacts. The CEO, Cristiano Amon, saying that they're looking ahead. They're building on the momentum that they've seen with their Snapdragon platforms and technology differentiation and connectivity, computing, and generative AI across everything: handsets, automotive, PC, XR, and industrial IoT, Internet of Things.
As we sort of get a read here, though, it's interesting. Another chip company is also reporting Qorvo out. Of course, they make a lot of the IF components that go into the iPhone as well as Samsung phones. Those shares lower in after-hours trading, even though they appeared to beat on the fourth quarter numbers here, but their guidance for the first quarter coming in a little bit light. I'm going to read that guidance to you. They're basically saying that revenue in the first quarter is going to be $825 million to $875 million for their fiscal first quarter. That's below what the street was looking for at $920, and EPS is going to be about half of what the street was looking for. They're giving a range of 60 cents to 80 cents for the current quarter. The street was looking for $1.29. Once again, a big supplier, Apple, their biggest customer.
All right, just to rehash again, guys, because we are definitely seeing these stocks move in the after hours, and we've seen Qualcomm certainly shooting up here on the news, now still up about, 4.5% here. But again, it does go to the outlook, right? This is what we want to know. And the company, I'm just looking at our right through now, giving a solid outlook and a sign of a smartphone recovery. They are, as Alex mentioned earlier, the world's biggest seller of smartphone processors, or Scarlett mentioned. They gave a solid forecast for the current period. So they are suggesting, at least our Ian King is suggesting in his right review, that the handset demand continues to recover. And this has been something that's been certainly some pressure on the company. But Scarlett, check it out. We're up almost 5% here after market.
Up 5%, but one thing that's notable here is that Qualcomm's Internet of Things group, which creates electronics for your refrigerator, your stove, your microwave oven, that is actually suffering from a glut of inventory, according to this Ian King story. Revenue for that business down 11%, even as we've seen the automotive sales, for instance, rise 35%. So it's not an even move higher here.
Yeah, that's such a good point. But it is the semis, really, and the revenue estimates for the third quarter on the high end looking at $8.1 billion. That's really helping in their licensing business. Also, QTL revenue on the high end, $1.4 billion. The question, I think, on the call is also going to be, when we get the AI smartphones, will there be a secular upturn, and what does that wind up looking like?
Yeah, I want to hear that, and maybe we'll hear that tomorrow out of Apple if they ever want to articulate an AI strategy. But it really raises the question as to sort of what gets us to that next cycle of smartphone adoption.
Mm-hmm. Does Qualcomm's chip end up powering that next generation of smartphone?
I think it wants to.
It wants to, but
to that point, though, remember, Mark, I can't remember, it was maybe a month or two ago, Gurman had some great reporting on this, saying that Apple was kind of behind, so that bought Qualcomm maybe a little bit more time. But we know that they're developing that own chip, and at some point they're going to try to move on.
Okay, we also have some numbers coming out of DoorDash. I'm going to pull that up right now. Let's go with the second quarter adjusted EBITDA. It sees $325 million to $425 million. Analysts were looking for $394.4 million on average. So DoorDash right now, you're looking at a drop of 8.5% for DoorDash.
Yeah, this is disappointing. I think, a lot of analysts, they are the largest food delivery company in the U.S. They were expected to show some signs of reaching profitability this year. So I'm not sure that investors are saying that this is exactly the sign they were looking for. But again, second quarter adjusted EBITDA, $325 million to $425 million. That low end, it would be extremely disappointing. The street looking for $394.4 million. So not necessarily the outlook the street might be looking for. Color on the call will be really important here.
Yeah, talk about color. Just one thing about Qualcomm before we move on here. Qualcomm saying that Chinese handset sales surged 40% in the first half full year of 2024. So they're going into their third quarter now. So just take into account.
Important
40%.
market for them.
Yeah.
Huge market for them, right? Yeah.
All right, some other earnings out there as well. Keep an eye on Etsy. Those shares down 10% here in after hours trading. At one point, they were down about 15% here. They beat on some of the top and bottom line numbers, but a big surprise on the gross merchandise volume, which unexpectedly dropped down to under $3 billion, a drop of about 3.7% on a year-over-year basis, which I think is where you're seeing the negative reaction. We should point out they did provide some EPS guidance, and that guidance also looks a little bit light as well.
Okay, you were looking at Etsy. I was going through DoorDash while you were doing that. There's a really interesting policy note buried in the press release here that talks a little bit about what happened in New York City and Seattle over the last few months when it comes to earnings. And for DoorDashers, they said, based on analysis of data following implementation of new earnings standards, we estimate local merchants will earn at least $40 million less annually from the DoorDash marketplace in Seattle and at least $110 million less annually from the DoorDash marketplace in New York City due to the new earnings standards. Sort of a rare policy comment coming from a company in an earnings release about recent rules changes.
Yeah, it's interesting too that, they've been adding so much to their platform, so you're trying to get an idea of how much this is necessarily moving the needle. But again, on the outlook and what they anticipate has got investors just setting the stock down almost 11% here in the aftermarket. All right, guys, kind of a bucket full of earnings there in some different sectors. So we'll continue to watch them here in the after hours and, of course, into tomorrow's trade. That is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again beyond the bell, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. A deeper dive coming up into all those earnings just crossing the wire right now. Qualcomm, Qorvo, Etsy, just to name a few. Stick with us. This is The Close on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal.
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to The Close on this Fed Day. I'm Scarlett Fu.
And I'm Romaine Bostic. A lot of price action today, but the net effect of it was, well, not really anything. In fact, right just before the Fed announcement at 2 p.m. today, the S&P was trading right around 5,020. It closed right around 5,020. Of course, that belies all of the price action and volatility that occurred in between, a more than 1% surge in the